Breakout failures are potent reversal patterns because of how they affect the traders who entered a long position and created the breakout. On pattern B, there is a consolidation and prices are contained within a range. Recognize both the high and low of any consolidation because we don't know if prices will either break out or break down. We have to wait and see what happens. Prices break out of the consolidation on pattern B. The breakout bar was created by traders who believed they will make a profit from higher prices. The breakout is followed by a potent reversal, which comes back through the point where prices broke out from. There will be increased selling pressure from the losing traders who created the breakout as they scramble to exit their position and limit their losses. Prices find resistance and consolidate for 2 bars on pattern C. Mark off the high of the 2 bars in the consolidation as resistance. Prices break out with a bullish range expansion, which is followed by 2 inside bars. The 2 inside bars show us there has been a stall in momentum. This is not exactly the kind of price movement the traders who bought the breakout want to see. The breakout fails when prices decline back through the point where they broke out from. This will cause increased selling as the traders who bought the breakout close their position to limit their losses. Prices find resistance on pattern D, where they consolidate for about 5 bars. Prices are consolidating at a prior resistance area from A. If prices can advance above the resistance area at A, some traders view this as a long opportunity because prices are breaking out to a new high. Other traders are focused on the 5-bar consolidation at D. If prices advance above resistance, they view it as a long opportunity. There are 2 different groups of traders who are prepared to go long if prices advance above this resistance. Prices advance above resistance and form a bullish range expansion that closed near its high. This is one of the largest green bars displayed on this entire chart. The bullish range expansion closed above resistance and near its high, indicating there was strong buying into the close of this bar. After breaking out, the bullish range expansion is followed by an inside bar. The breakout fails when prices decline back through the point where prices broke out from. This breakout failure is the most potent failure on this chart. Breakouts to new highs attract a greater number of traders entering long positions in comparison to the average breakout. When this breakout failed, there is a greater number of traders who are now caught with a losing position. Prices decline and find support at E, where they consolidate for several bars. Mark off the high of the consolidation as resistance. Prices break out from resistance with a bullish range expansion, which is followed by a bearish 180 reversal, trapping the traders who entered a long position. Understanding how pattern failures affect the psychology of those who created the pattern is key to understanding when a new move is beginning. A breakdown is when prices find support for a minimum of 2 bars, then decline below that area. Increased selling that overwhelms buying is what causes price to move below support. Prices decline on pattern A until they found support for 2 bars. Mark off the lowest point of the 2 bars as support. When prices decline below support, that is when a breakdown has occurred. Pattern B found an area of support for 2 bars. The tails of these bars are not even. They don't have to be. Prices are contained within an overall area. Support is not an exact price point. It is a general area. When prices are contained within an area, recognize the lowest tail in the consolidation as the breakdown point. Mark off the lowest tail as support. When prices decline below support, that is when a breakdown has occurred. Prices declined on pattern C, then found support and rallied. The turning point at the low is an area of support. Mark off the lowest tail at the turning point as support. When prices decline below support, that is when a breakdown has occurred. On pattern D, prices found support and formed a multiple bar consolidation. Mark off the lowest tail within the consolidation as support. When prices decline below support, that is when a breakdown has occurred. Pattern E formed 3 bars that are contained within a range. The lows of these bars are not equal. That's okay. Prices are contained within a range. Mark off the lowest tail in the consolidation as support. When prices decline below support, that is when a breakdown has occurred. Breakdowns form in many different ways, but the reason prices broke down is always the same. Prices break down because selling overwhelms buying. Let's go over some of the different ways breakdowns form. At pattern A, prices are consolidating in a range. Mark off the lowest point in the consolidation as support. When prices decline below support at B, that is when a breakdown has occurred. Prices find support and consolidate for 3 bars at C. Mark off the lowest point in the consolidation as support. When prices decline below support at D, that is when a breakdown has occurred. Prices decline and find support for 2 bars at E. Mark off the lowest point of the 2 bars as support. When prices decline below support at F, that is when a breakdown has occurred. Prices quickly find support and consolidate for several bars at G. Mark off the lowest point of the consolidation as support. When prices decline below support at H, that is when a breakdown has occurred. Prices decline and find support for 2 bars at I. Mark off the lowest point of the 2 bars as support. When prices decline below support at J, that is when a breakdown has occurred. The traders who entered a short position on pattern A have expectations to make a profit from lower prices. On pattern B, when this bar closes at its high, those traders' expectations have been reversed as they quickly found themselves holding a losing position. Failed expectations are powerful because traders are caught on the wrong side of a trade. When traders get caught on the wrong side of a trade, there will be increased buying or selling as they exit their losing position. Increased buying that overwhelms selling is the only thing that can cause prices to advance. A breakdown failure forms when prices advance back through the breakdown point. When prices decline below an area of support, it is because there was increased selling that overwhelmed buying. The short sellers have expectations that they will make a profit from lower prices. If prices immediately advance back through the point where prices broke down from, it changes the expectations of traders who sold short the breakdown because they're now holding a losing position. This will likely lead to an increase in buying as the losing traders close their position. Breakdown failures are potent reversal patterns because of how they affect the traders who entered a short position on the breakdown. Prices consolidate for 2 bars on pattern B. Prices are consolidating at a prior support area from A. Mark off the low as support. Prices break down below support with a bearish range expansion that closes near its low. Following the bearish range expansion, prices form an inside bar. When prices advance above the point they broke down from, traders who created the breakdown will close their position to limit their losses. This will cause increased buying and drive prices higher. On pattern D, prices found support and consolidated for 3 bars. The support from D is at a prior support area from C. Mark off this area as support. Prices break down below support and form a bearish range expansion that closes near its low. Following the bearish range expansion, prices form an inside bar. When prices advance back through the point they broke down from, the traders who created the breakdown will begin closing their positions to limit their losses. Prices consolidate for 3 bars at E. Prices break down from the consolidation and form a bearish range expansion followed by an inside bar. When prices advance back through the point they broke down from, the traders who created the breakdown will close their position to limit their losses. The increased buying from these traders will drive prices higher. Prices consolidate on pattern F. Mark off the low of the consolidation as support. Prices break down from the support and form a bearish range expansion. Prices form a bullish 180 reversal, and the expectations of the traders who created the breakdown are immediately trapped. The size of the 2 bars show us there was an increase in traders who are associated with these bars. The more traders there are caught in a breakdown failure, the more buying there will be as those traders close their losing position.